Hi there, traders. Welcome to Admiral Markets. My name is Chris, and today focus on strategy webinar, taking a look at what are the setups with the highest probabilities, so that we get the better odds in our favor. Now, before we dive into today's topic, but also of course taking a look at live charts, first be aware that this webinar is shown to a global audience, but may not be suitable for everyone. Please visit admiralmarketsglobal.com. Select your country of residence and contact the appropriate entity for more details on that to find out if it is suitable for you. Also, please note that trading foreign exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. Alrighty, so we're going to dive into the strategy topic of this month, new month. So we have a lot to look at, a lot of monthly candles we can review. I mean, I don't think we'll be looking at every single one of them. It's a bit tedious work, but we can take a look at the majors and see what kind of info we can get as well from some of these monthly candles. And yes, these monthly candles are pretty useful when analyzing. You can find some interesting setups from that, just from these candles. But we'll be diving into patterns as well and moving averages and trying to show what kind of setups are typically the highest probability. So what am I showing here? Well, it's basically the website, admiralmarkets.com. Check it out after the webinar, just in case you're starting the first time with this webinar with us. You can find more info about our analytics, for instance, here with a lot of analysis, but also some good articles and tools, by the way, so like Artichart, market sentiment, market heat map, etc. Then there's some other interesting tabs, for instance, MetaTrader 4 or 5 Supreme Edition that you can download with extra features and stuff like that. Education, of course, as well. A lot of education, in fact, here at the bottom, articles, webinars, and of course, just plain old-fashioned information about how to trade. All right, and that you can find right here in these buttons. All right, so let's take a look at the market now. This is one of those extra features here. The mini terminal is part of the MetaTrader 4 Supreme Edition. Also, the Keltner and the Admiral Market pivot points, by the way, are 3 of those 60 plus extra features, by the way, that you can check out if you like. So let's review this Eurodollar, for instance. So what are higher trade setups? Typically, trade setups where we are looking at a trend. Typically, a good trending chart is the 4-hour chart, for instance, but not every time the trend is necessarily very neat or very clear. So what we can be trading on the 4-hour chart is a momentum or a trend. The momentum is one piece of price action that keeps going without much pause. A trend is where we have basically, this is momentum, right? Up and down. Whereas a trend is where we have a sustainable angle and price is making down, then making a correction up, then making it down, correction up. So, on a 4-hour chart, these are the best situations. It's okay to trade momentum as well, but to be able to trade it, you need to either catch the candlestick pattern at the beginning, all right, or you zoom into lower time frames and you try to catch within that momentum some parts. A bull flag or bear flag on a 30-minute chart, 1-hour chart, 50-minute chart, somewhere halfway or at the beginning to catch that momentum. All right. So these are typically the highest probability trade setups. Trading when the market is moving fast or when it's setting itself up for a fast movement by making a correction like this. Now, it's always never hurts to take a look at the daily chart if you're using the 4-hour chart as a trend chart, just to spot important support and resistance levels, tops and bottoms, and stuff like that. Also, looking at patterns on the 4-hour chart is important. For instance, if we see momentum and then we see not only price retracing, but we see kind of a rising wedge here within a channel and it's approaching resistance, that too is a high probability setup. Furthermore, we should also keep an eye on if it is trending that there is no divergence. Divergence could send the chart to a retracement and could make the reversal actually even occur. So lack of divergence is important for a trend setup. All right, if there's divergence, then retracement or reversals are possible, depending on the exact circumstances. If there's double divergence on which time frame, that increases the likelihood if it's on a higher time frame. If it's on a lower time frame, we need multiple divergences before a reversal is more likely. So those are things you need to keep an eye on: patterns, trend, and supportive resistance. And regarding patterns, we're talking about chart patterns and divergence patterns. We're talking about trend and momentum, I already discussed, and supportive resistance. Not trading it too close to supportive resistance when you're trading a momentum or trend with the momentum or trend. So, generally speaking, trend, pullback, continuation. But even the safest setup is maybe trend, pullback, break, small pattern, continuation. Excuse me, right here. That little consolidation on a lower time frame. That I would say is probably the highest probability setup that we could find. So sometimes you have to hunt for the right time frames to find that one, but if you do, it's typically the best one. All right, some might say reversals. I disagree. I don't think reversals are the best or the highest probability ones. I think this is the ultimately the best. Now, of course, news events could change that environment too, something that you have to be careful of as well. So let's see if we can find something recently on the euro dollar. Excuse me. Now, we didn't really have much of a trend on the euro dollar. It was quite rangy, up and down, strong momentum, but up and down. So let's take a look at this push down, for instance. All right. So we have strong momentum, correction higher, and price breaking through support. So this particular break is already something that could be interesting because you have momentum, pullback, continuation. Let's analyze the 4-hour chart quickly. It's a bit difficult to do multiple time frame analysis at this point, but it's a bit difficult in the sense that we might lose the spot where we had it, but I put a vertical line there so we know. All right, it's not really a downtrend as yet. We do have lower lows and lower highs, definitely lower highs, lower lows partly. We have also the support line. It's more like a triangle with a potential head and shoulders. So I remember this. We were looking at, if I remember correct, no, wait, I'm not sure. Yes, I think so. We were looking for downside actually here. But in any case, it's not a great 4-hour trend. So it's maybe not the best example. But we do see some reversal signals. We do see lower highs. So and we do see price retesting resistance. So a break here is not that strange of a trade idea. All right. So we have the 1-hour break. That is one trade idea with a high probability in my view. But perhaps a better probability, now this is a bit unfortunate because of the weekend, but even after the weekend, right, we get a break, consolidation right here. So we have break, consolidation, and a break. So it is the break of the break. Typically, I like that one for a high probability setup. And the reason why is the reason why that it's better than any trending trade, any normal breakout, is because when you have the break here, that break, we don't know if it's going to end up well. It could break, but then close in reverse like this. But if it then makes a correction on the lower time frame, typically that correction is small, doesn't last too long. It's on one time frame lower, like if we're trading the break on a 1-hour chart, look at the 50-minute chart, it'll be typically something like this. And if you trade the break of the break like this right here, then typically that works pretty well because we had first of all, some reason to think about the break here. Then we got the break, and then the break, the movement after the break didn't go anywhere. A correction, consolidation, and then it breaks below that. So in that case, typically there's no danger, there's no reversal danger here, and you know a closing reverse is unlikely. In this case, downtrend continuation or bearish break continuation is likely, and indeed, boom, down it went. One more pattern, in fact, bear flag, and then again, boom, down it went. Right, break, pullback, continue. A smaller flag. This was a big flag. This was a small flag. This is more like a 5-minute flag here. Another 5-minute flag, and then eventually it runs out of steam and corrects. All right, and then we got some, I don't know, some funky little correction, and even one more lower low. Now all these flags, all right, are potential setups, but are they the highest probability setups? No. Eventually, I would say the second breakout, let's say the break after the break is the highest. Then maybe the next one is still pretty decent, but then the odds are slowly but surely decreasing. It could still work depending on how much momentum is available in the market. The next breaks could still work and do fine, but eventually there's going to be a break at the very end that is going to slam into some problems, and we get a bigger retracement. Now with this euro dollar, that happened a bit lower, but eventually it did happen, double bottom, and we got a bigger retracement or reversal. And in this case, well, I guess retracement, because it still seems to continue higher. We can check it very quickly. There we go. And indeed, after the breakout, you can see here, flag, correction, smaller corrections here. You see that? Flag, break, and then we got the double bottom. And then we got a bigger correction. Then we still got one more break, one more lower low. No, two more lower lows even after that. But these were more like 1 hour corrections. And I do believe that after that, we finally went up indeed. More up. So usually these momentums, these pushes will not last forever. And that's why we have to be realistic, of course, about how far this can last before there's some kind of correction. How far this can last before there's some kind of correction. That's why when you take a break like that, very important also to find the good exit points and use meaningful trail stop losses. Because if there's one thing that I would advise is the fact that, you know, taking entry is maybe not even the most important, in the sense that if you exit properly, you should be able to get some good pips, even if you only win half of your trades. At the moment, this week, I'm only half of my trades are winners. Last week we had 75%. But even despite that, still doing well, in the sense that still up a couple of hundred pips and some, I think, 5.5% of units of reward if you take 1% risk, because I kept the losses small. On average 0.4, I think 0.35, and the winners are still twice as big on average or more. I'm not sure now. So trail exits and trail stops is another important aspect of actually high probability setups, or maybe not high probability setups, but with regard to a good reward to risk ratio, I should say, probably. But in any case, I think you get my point. If not, feel free to use the chat. So what kind of trade management style I use? I like to use a style where I give the trade at the beginning some time, then after a while, and this is after a while, that's a difficult thing to explain. Unfortunately, I do think we have, luckily, a trade management webinar you can find on YouTube with Admiral Markets. I make it tight again. That means move to break even, or make a small loss, or if possible, go into positive territory, then give it a little bit more space again, the trade, and then when it gets closer to take profit, or it takes too long, then move it to tight again, the stop loss. Sorry, the other way around, loose, no, loose, tight. So first, loose, tight, loose, tight. That's my magic formula. Unfortunately, how to do it is a little bit more tricky, and that takes a little bit more experience. But we have that trade management webinar, luckily for that. So I can give you an example maybe quickly. Let's see. Euro New Zealand upside actually took a very small loss on that myself. This was a signal according to my system, but this too, I think, if I remember correctly, I took this one, I believe. But I put the stop loss, normally I had the stop loss here, and I moved it quite tight behind these candle highs. Only lost about a third of my risk, maybe 25% by moving that. And why did I do that? Well, part of the reason was it looked like a rising wedge to me. On a 1 hour chart, you can look at that, see that a bit better. All right, and it tried to break out on the hourly chart, which was a good sign at that point. But on the 4 hour chart, we had a wick at the end. So either it was a filled break of the rising wedge, which would not be good for my long. So, didn't want to get stuck in, and if it is a rising wedge, then this could be an ABC. There was strong momentum here too, despite the uptrend on the Euro New Zealand. And that could be typical for wave B. And that this is a wave A and this is a wave C. And that I was catching the tail end of the wave B, which in retrospect was true indeed. So it was a loss for me, but a small loss, and really doesn't do much damage if it's break even or 0.2 loss or 0.3 of the original risk. And yeah, that's just one example. So then, for instance, Euro Yen today. All right, I was looking for a break of the Euro Yen of this support zone, for instance, but we didn't get it on the daily candle here. And instead, the day after, we got a bullish candle. And if we looked at the lower time frames, it was not necessarily a trend that I was trying to trade. It was a bounce at support because it didn't break, but it bounced with good momentum on the daily candle and good momentum on the hourly candle. All right. And on a 50-minute chart, I then saw this correction, ABC. So I have a bounce at support with good momentum and a good daily candle close and a sideways correction. To me, it seemed likely that it would break for a high and break this high for one more push higher. That's typical when you have momentum like that, strong support also, so there's a good chance that it will continue. Question is to find a good target because it doesn't have to go necessarily very far. It could, but it doesn't have to necessarily. Which is why I put the target at the minus 272 target. And on a 50-minute chart, I managed to get a 2-to-1 reward to risk. The stop loss was below here. I entered somewhere here as it was bouncing after this ABC. And I got about 38 pips, I believe, and 19 risk. So I lost 0. Let's say even 0.3. I think it was actually 0.25. Okay, let's say 0.25 then. On the Euro New Zealand. But then I gained 2.0 on Euro Yen. So the total is 1.75. The funny thing is that I actually lost maybe about 50 pips on the Euro New Zealand because, no, maybe it was 20, 30, let's say, probably. I think the total risk was like 105. So maybe 28 or something like that. And with the Euro Yen, I maybe 138. So the net gain is 10 pips only. So that's why, pips themselves don't really necessarily mean everything. Of course, typically, if you're up in pips, you should be earning. But here's an example where not many pips were made, but due to the R2R, money actually was made still. And from this perspective, you could lose 5 trades, each 10 pips, right? And each 1% be down 5%. Win one trade of 200 pips, be up 150 pips, make 2% on that trade, be up 150 pips, but still be down 3% of equity. In theory, right? Um, so be careful when people only talk about pips, in my view. It's also good to ask for look at the reward to risk ratio and the equity itself, not only the pips. Anyhow, generally speaking, though, pips, this is a bit of a hypothetical example, obviously, do indicate uh, potential growth. How is the name of the indicator with a line green and yellow on the screen? Oh, this. That's a moving average indeed. That is my holy grail. If it exists, then it's this for me at least. And together with the oscillator, it's my roadmap for understanding the market. If you want that indicator, you can get this indicator for free. It's just it's a normal moving average, but it indicates it gives a green color with a bullish angle and an orange color with a bearish angle. All right, so let's take a look if there's anything now at this moment. Euro dollar maybe did break. I was thinking, or I was, indicating that I was looking for a break below the support. In retrospect, I don't know if that was so smart with F1C around the corner, but let's see. Um, from this point of view, we got the break on the hourly chart. So what we really need is a pattern on the 50-minute chart, and we don't get that. So for the moment, I would say not a high probability not a high probability setup on the euro dollar for the moment. Not with a news event around the corner. Pound dollar seems to be making a bit of a retracement here. Dollar yen 2 at the resistance spot. Aussie, you see one of the reasons, this was, in my view, high probability setup. Made a downside, but I trailed it above these tops because if it breaks above that top, I know that in that case, price is making an extended correction. So I thought pretty good probability setup here with the break because there was a good downtrend. But the trade management, trail and trade management in this case helped me get out for plus 5 pips, which is nothing, of course, but better than a loss. So that was trade management that helped me with that setup. Kiwi is didn't break below this support. Sometimes tricky, isn't it? Like it kind of tricked me in a way because it was making a decent size bear flag, i.e., which is, from my point of view, made it a higher likelihood that it was going to the downside. But that support never broke. So one thing that doesn't help high probability setups, right, or setups with high probability to get high probability is if they're at a key bottom or very strong confluence of support. Yes, it can break, but as you can see here, it certainly doesn't have to. So it's not as it's not that um, as probable. It's just a spot that it's an average spot. It's a spot where price could break, price can bounce. It can go with the news, as Andre says. It's vulnerable to that, right? It can go with the wind. It's like a piece of paper on the street. Then if the wind blows it to the left, it will go to the left. If it blows it to the right, it will go to the right. The news was good, so it went up. It is a vulnerable spot. It is a spot where it's tradable. I'm not saying it's not tradable. It's just that I wouldn't consider it a high probability spot. It's a bounce or break spot. It will do one of the two, and hopefully there's a way to follow that trade to one side or another, maybe for a few pips, right? Maybe on a 50-minute chart, if you see a momentum like this and you see a bull flag like that, right? That's a high probability setup actually, right here. right? Maybe you don't see it that good on the 15-minute chart, but on a 5-minute chart, you might see it a bit better. A, B, C. Connect the resistance trend lines like this. The break, or if you don't like the break, wait for maybe a little bit of a correction like this, and the next break like that. Or this is the original breakout candle, or the continuation candle. These could have been all three potential setups. If you're not looking for a 5-minute chart but a 50-minute chart, then probably this candle right here would be the one. Typically, when there's strong momentum like that, and then a correction, there's a high chance of continuation. That's a high probability setup if you have momentum like that. And a correction, because what can happen sometimes is you have high momentum, high volatility, it's a spike, and price flies back down. That has happened in the past. Lately, not so much. I don't remember that happening too much. A few years ago, definitely remember that this happened more often. It doesn't really ring the bell recently, but still, the pattern is important because that indicates that momentum is the dominant factor, and if it breaks that pattern, that's a very good example of a high probability setup. In fact, on the Kiwi, don't be too ambitious with that though, because in fact, it didn't even get to the minus 272 target. So that, it's questionable if the target would get hit 69.34 and went up to 69. So probably trail stop loss would have had to be used below this bottom. So not much profit there, but still a good probability setup because of this momentum. And typically you get at least one divergence before you get a bigger retracement, and maybe sometimes two. So from this perspective, this is also even a tradable formation. It's not a high probability setup in my view, though. But it is an option. There is basically a pullback to the 38.2 fib again, small flag here, so there could be a breakout and continue there on the Kiwi. Good 1 hour engulfing twin. Well, not good, but at least something there. 4 hour candle looks a bit dangerous though. It's a risky trade. It has been in a downtrend quite long, and will this correction go further? That's really a big question mark. It's really not a high probability trade at all, in my view. Now, at least. All right. Just scanning some of these charts here quickly. My internet was a bit down earlier today, so I am running a little bit behind in the sense that I just got back online less than an hour ago or so. Unfortunately, they were upgrading doing some work with the TV and knocked out the internet for a few hours, unfortunately. I have a backup one, but that didn't work. I bought it 2 years ago and as a backup, but never needed it. Now I need it, but didn't know how to. After 2 years, I guess I don't know. It guess didn't work or so. I guess. Mm, let's see. Any high probability setup at this moment. I must say I really didn't see much today. I don't. Last week there were a lot more setups in my view. A couple of setups today. One I was looking at was Pound Cat. That didn't work out that well. Went for a loss. Syrian went for a win. Um, some of my daily yen trades were small wins. The bigger Pound Cat trade was a big window from Monday. Let's take a look at silver maybe. Really low volatility on silver at this moment. I mean, relatively compared to some of the months prior, as you can see. Small candle relatively. I mean, we're talking about just a bit more than $1 difference between high and low. But eventually, I think that this is setting itself up for upside, in my view at least. It is, to me, looking like a correction. And if it breaks this correction, it should go higher. There's momentum here. So after this correction is finished, I would expect momentum to take it up again. Let's see, anything else? New Zealand cat was maybe something of the past, and this is maybe something that is good to analyze divergence here. All right, so there was divergence between these bottoms. If you look at the hourly chart, at least, here you go. See, between these bottoms. Then we had momentum to the upside. We had a correction like this, and then we had a break. Triangle. All right, so let's go up to the 4-hour chart again. And from a support and resistance point of view, well, maybe resistance, but way higher, not necessarily nearby. Like this. Maybe even resistance up in here, this small little zone there, right? But besides that, a break to the upside or downside for that matter, I think was a pretty good, maybe high probability setup, maybe a bit too much, but a decent probability setup there. All right, so sorry, just got distracted there for a second. So let's go back to this New Zealand cat. Yeah, so break, and then a flag. In fact, you can see that a bit better on a 5 and 50-minute chart, or 50-minute chart, maybe even better. Break and flag, and yeah, the break itself here, is late, um, in the sense that a lot of that potential space has been eaten up already because this is the resistance zone. So in this case, yes, there's a flag here too, but I wouldn't say that this is a high probability spot despite the momentum because of the resistance zone. That could be that was a bit different on the New Zealand dollar. All right, this breakout would have had to be traded either at the breakout candle or upon this candle as it makes a little flag here and breaks. And then we had the news probably that helped it, but still, the analysis is the same. All right, it's still valid despite that. That's what I meant. In any case, you can see an example of how divergence works as well and helps analyze and give an idea which trade setups could be interesting and could give some trade setups more how do you say it, in a sense, aid certain ideas, whereas in other cases it invalidates some ideas, right? So for instance, the downside idea here might be less interesting because of the divergence, right? For instance, um, some other idea there's maybe no divergence, which confirms the potential and makes it higher probability that their setup will occur, etc. Another thing, strong candles help as well, very much so. In fact, we can see an example here where we have a resistance line, a support line, and a breakout candle like that. Oof, Very, very good, indicating a lot of volatility and therefore a lot of strength, and a good chance that there will be follow through. A candle like that helps a lot with indicating that this break is good and there should be follow through. A lot of traders are scared to take a breakout trade like that because it's a big candle and they think it's a big stop loss. Depending on the circumstances, of course, but mostly if there is a good candle close, in many cases, if there's space to the next resistance, there's nothing blocking it necessarily, then there's a good chance of follow through just based on that volatility candle. All right, so candles, candle closes, pattern after the pattern, divergence or not. Those are all useful concepts to support a resistance, to understand, how if your setup is one of the ones that has high probability, or is it a 50-50, or is it slightly more likely, etc. One, for instance, I didn't think was a high probability one, but ultimately thought that it was going to go to the downside was when the euro pound broke this support trend line. From my point of view, bearish candle near the close, near the low, breaking through support. I thought it was bearish. I thought it would go down, but I thought I'm not a big fan of the euro pound, so I didn't trade this one myself. I didn't think that was really that. It seemed likely, but was it a fantastic setup in my view? No, I'm not, because I'm not a big fan of the euro pound. But we don't necessarily have to have fantastic setups for them to work. This one did work, although I didn't take it. So that bar is sometimes difficult to set. I mean, do you take trades that are iffy, or do you wait for the ones that have really high probability? It's a difficult balance sometimes, and depends on how the trading week has gone, maybe on our mood as traders, what kind of other opportunities are there available. Obviously, we don't want to be too nitpicky and wait for one trade in 2 years. We wouldn't gain too much from that, right? Even if that was one great trade. So it is a tricky balance. Like for instance, today I, traded the pound cat upside. Definitely had some hesitations with that, right? It ended up in a loss. Definitely knew that there was a risk for that. Still went for that. And it was not a high probability setup in my view. Still decided to go for it. And I'm just trying to find the chart. 1 second. I can't find pound cat. 1 second. It must be here somewhere. It didn't go away. Yeah, there it is. And I knew that there was 1 hour divergence, for instance. I knew that pound and the cat were tricky spots. So, yeah, maybe I shouldn't have gone for it. That's always easy in retrospect. I knew it was this divergence, but I was looking at this 30-minute chart and 50-minute chart. And I was thinking, wow, this is really big momentum. Still one more flag and one more push higher, and then it will probably retrace. Technically, it did kind of actually make a higher high. It just didn't hit my target, in fact, to be very precise, probably. And what I was aiming for was the minus 272 target, and then it didn't get there. And I missed it by about halfway. And I guess I missed it by about, I don't know, 25 pips. So this was not, despite the fact that there was momentum, maybe not a high probability one, in my view, because it was, it was already strong trend channel, sure. Took this trade already earlier this week. But it did have some signs of potential turn here when looking at the oscillator and on the hourly chart. And I knew the risk that it might not make that upside was there. So this was an iffy one. It was 50-50 and it just didn't work out. It was definitely not a high probability one. Certainly not. But still thought it was worth it due to the momentum, certain elements I saw, and this is a tricky balance. Where do you cut the line? Where do you say I skip it? Where do I continue? It's sometimes not easy. With the Kiwi, it was still tempting to trade it despite the support there, and I did. But I, got out for break even, luckily. And this can happen sometimes in certain weeks where the market, if you're looking for trend continuations like I did with the pound CAD and the Kiwi, and you don't get it. Sometimes you get these smaller kind of losses, or sometimes bigger ones. Pound CAD was like half, I think, half the loss. No, a little bit more. No, it was more. It was 80% or something like that, I believe. All right, but pound CAD earlier that week was a great trade. Just the same currency pair gave 206 pips. Here. This was a high probability setup in my view. Trend, no divergence, bull flag, break of bull flag, and boom, up it went. Plus 206 pips. That was a better one. That was a higher probability one. Any questions so far? Of course, measuring probability is something that either is an estimate by us, or if you have a system that you backtested either through an EA or maybe even manually, old-fashioned way, by using a pen and paper, really old-fashioned, or a spreadsheet, a bit more modern. Then, of course, you have, in fact, at least a historical idea about that system. Or you are trading a certain way and you're tracking it on MyFXBook or something like that. That also, of course, gives you some idea. I'm now just talking about estimating it ourselves. And the best tips from my point of view are candlestick closes, candlesticks, this candlestick volatility, the patterns, the break after the break, and support and resistance. Those elements, I think, are the most valuable in assessing whether that particular setup, that unique setup, though, although price repeats itself in patterns, has a high probability of working out. All right, so I got some questions. How to use ATR? Well, I'm not the one who uses ATR, but you could use ATR for stop loss placement. So if the ATR is high and the volatility is high, therefore that you use a wider stop loss, for instance, and a wider target. It's one way I've heard people and traders use it, but I'm not. That's not something I've used, so I don't know. I think Awesome Oscillator, well, it is the same, I think, as a MACD, to be honest. It's just that I'm used to this one. Um, if you compare it with, MACD, it's typically not so much different, really. If you use the normal MACD, there are special MACDs, then there's some difference. Not much difference. It's about the same, actually. If you use a special MACD, then you should see these lines as well, the red and the blue. Now you don't see it. So that's why I like the AO, because you see blue, red. But with this normal MACD, you don't. I think with special MACDs, you should. How to spot fake flags? The best, I think, is to look at support and resistance. Because if you have momentum, like the Kiwi, New Zealand, so we have momentum to the downside, excuse me, and then we have a flag, but there's support level. What is that support level? It's this daily chart. So we have momentum, flag, but there's a major support level here. It's a flag, but it doesn't have to necessarily break to the downside. This could be making a corrective pattern at support because it's not able to break through support, and later on actually do the opposite. Let's see. There's an extra comment like downtrend, and then I have a triangle flag or wedge trend. Well, if you're trading a reversal wedge, like a rising wedge or a falling wedge, those are generally speaking pretty difficult. What you want to see, I mean, with a rising wedge, it's good to see divergence. Typically, I mean, on a higher time frame or multiple time frames. So if we see, for instance, a trend like this, and then we see here a rising wedge occur like this, and there is already divergence between these tops, for instance, and then there's divergence between these tops. Yes, then reversal wedge will work out pretty well normally, but they are on average more difficult because sometimes you have what looks like a wedge and then just breaks to the upside, or if you have a falling wedge, it just breaks to the downside. In fact, so the wedge itself is often not enough. Also, if there's a triangle, triangles can break to both sides in theory, of course. So if you have momentum to the upside and then a triangle, typically the triangle break to the upside is a better trade. Doesn't mean that it's impossible that the price can break to the downside in that triangle. Got to keep an eye on both. In fact, even with bull and bear flags, if you have, for instance, move up and you have a bull flag like this, right, still good to keep an eye on both levels because if it breaks the support of the bull flag, then it could be a bigger reversal or retracement. And last question, how can I see more Fibonacci retracement levels? So if you add the fib, what you need to do is click on the fib, right click on it, left click on Fibo properties. Then here you should be able to add. All right, so here you should see some levels and you can click on add. And then add the levels, like I have 23.6, 38.2. Add a space, percentage, dollar sign to get the exact level next to price. So here you see, next to the fib. So here you see the fib, and if you have a space, percentage, dollar sign, you get the price level added to. All right. There we go. So that's how you want to do it. Right click, Fibo properties, add, and you want to do the level 0.23.236 for the 23.6 fib. And here in the description, you can write anything you want. That's your own way of describing it. In the level, you want to add 0.5, 0.618 for those fibs. All right, folks. Well, that gives some clue about how I look about probability setups, higher probability setups, and how I analyze that. And if you're looking for more info on trading, tomorrow we have a webinar again, and we're going to take a look at, together with Neneth, we'll have our Pro Learning Lab webinar. We'll take a look at the role of the US dollar in the global economy. If you're looking for more info about MT4 or MT5 Supreme Edition, the extra package from Admiral Markets, click on Platforms, and then go to here in the middle, Supreme Edition. If you're looking for more analytics education, all of it right here. And if you want to start trading, just click on Start Trading to get a demo account or real account, etc. All right, so hopefully see you tomorrow. Hopefully you get some good pips in the meantime, and see you all soon. Cheers.